Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Energizer Holdings, Inc. quarterly report. Energizer Holdings, Inc. offers a diverse range of products and services across various categories. The company's product portfolio includes household batteries under the Energizer, Eveready, Rayovac, and Varta brands, as well as specialty batteries for hearing aids. In addition to batteries, Energizer also provides a variety of protectants, wipes, and cleaning products under several brand names, including Armor All, New Finish, and LEXOL. The company's automotive division offers fuel and oil additives, functional fluids, and other performance chemical products under the STP brand. Energizer's lighting segment includes handheld lights, headlights, lanterns, area lights, flashlights, and other related accessories. The company also licenses its brands to develop consumer solutions in solar energy, automotive batteries, portable power, generators, power tools, household light bulbs, and other lighting products. The company sells its products through a variety of channels, including direct sales force, distributors, wholesalers, retail locations, mass merchandisers, warehouse clubs, e-commerce platforms, and military stores. With a global presence, Energizer Holdings, Inc. is a leading manufacturer and distributor of household batteries, specialty batteries, and lighting products worldwide. Energizer Holdings, Inc.'s stock price has experienced a significant decline of over -23.54% in the past year, primarily due to several key news events that have negatively impacted the company's performance. One major factor contributing to this decline was Energizer's disappointing Q3 2025 earnings report, which fell short of profit expectations and presented a bleak outlook for future sales and earnings. The company's adjusted earnings per share of $1.05 were nearly 10% below expectations, while organic sales declined by 2.2%, indicating weaker consumer demand. Furthermore, Energizer's fiscal Q1 2026 results showed soft demand and margin decline, with a 4.3% decrease in organic net sales attributed to a 4.5% drop in volumes due to softer consumer demand in the U.S. across both its segments. The company's adjusted gross margin also declined, driven by increased input costs, higher tariff costs, an unfavorable product mix, and the lower margin profile of its Advanced Power Solutions (APS) business. Additionally, Energizer's Q2 outlook for 2025 included predictions of flat to a 1% increase in net sales, hampered by a strong U.S. dollar. The company's adjusted earnings per share were expected to decline due to increased investments in digital transformation and growth initiatives. These negative news events have collectively contributed to the significant decline in Energizer Holdings, Inc.'s stock price over the past year. Energizer Holdings, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Energizer Holdings, Inc. trades at a lower price-to-earnings ratio of 8 times, and a higher price-to-book ratio of 11.31 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 96% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 5.14%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. On one hand, several factors contributed to revenue growth. The batteries segment saw a significant increase in sales by $59.6 million, representing a 9.8% growth from 2024 to 2025. Additionally, the APS acquisition added $64.6 million in net sales, while Project Momentum and Belgium acquisition also made notable contributions. On the other hand, revenue decline was driven by several factors as well. The North America market experienced a decline of $32.7 million, representing an 8.4% decrease from 2024 to 2025. Furthermore, the auto care segment saw a net sales decrease of $5.6 million during the same period. The United States also witnessed a -6% decline in revenue. It is worth noting that organic growth and currency impact are not explicitly stated as primary drivers of revenue growth or decline. Net income for the company experienced a significant decline between 2024 and 2025. The net income decreased from $22.3 million to -$3.4 billion due to several factors. A substantial drop in net sales, an increase in the effective tax rate, and losses on debt extinguishment or modification all contributed to this decline. The profit margins also saw a significant decrease during this period. The gross profit margin dropped from 36.8% in 2024 to 33% in 2025, while the operating profit margin decreased from 4.1% to -0.6%. These declines were largely due to various costs such as restructuring and related expenses, network transition costs, acquisition and integration costs, and losses on debt modification. The segment profit margins also experienced a decline, with the batteries and lights segment seeing its profit margin drop from 18.9% in 2024 to 15.3% in 2025, while the auto care segment's profit margin decreased from 20.7% to 9.1%. The company faced challenges such as inflationary pressures, geopolitical instability, higher commodity costs, tariffs, and network inefficiencies that negatively impacted its profit margins. The decline in net income and profit margins can be attributed to a combination of internal and external factors. While the company's financial performance was affected by various costs and expenses, it also faced macroeconomic challenges such as inflation and geopolitical tensions that further exacerbated its financial difficulties. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved a substantial increase in net cash from operating activities, reaching $149.5 million in 2025. This positive trend suggests that the company is successfully managing its day-to-day business and generating sufficient cash to cover its operational expenses. This achievement is a testament to the company's effective financial management and operational efficiency. The generation of positive operating cash flow indicates that the company has a solid foundation for future growth and can invest in new initiatives without compromising its financial stability. Overall, this development bodes well for the company's long-term prospects and provides a strong indication of its ability to sustain itself financially. The company's debt level has undergone significant fluctuations over the past year. Initially, the debt level decreased from $857.9 million on September 30, 2025 to $765.7 million on December 31, 2025. However, this decrease was followed by an increase in the senior secured term loan of $92.2 million in the first fiscal quarter. Furthermore, short-term debt due within 12 months also increased from the previous period. In terms of interest expenses, there is evidence to suggest that they have increased. Net interest expenses rose by $2.1 million, and interest expenses themselves increased from $37 to $39.10. Additionally, debt issuance costs of $1.50 may indicate a further increase in interest expenses. Overall, while the company's debt level has seen some fluctuations, there is clear evidence that interest expenses have risen over the past year. The company's performance in the batteries and lights segment was a mixed bag, with net sales increasing by 8.3%. However, this growth did not translate into increased profitability, as segment profit declined from $119.3 million in 2024 to $105.7 million in 2025. On the other hand, the auto care segment struggled significantly, with net sales decreasing by 5.6% and segment profit plummeting from $20.5 million in 2024 to a mere $9.1 million in 2025. This decline suggests that the company's efforts to improve its performance in this segment were unsuccessful. Overall, while one segment showed some growth, the other struggled, indicating areas where the company needs to focus on improvement. Management's outlook for the company is marked by uncertainty, with operating results for any quarter not indicative of full-year results. They are assessing the impact of new accounting pronouncements and defending against pending legal proceedings, which they believe have substantial defenses. The company faces various risks, including the failure of key IT systems, attracting and retaining employees, credit ratings, sustainability issues, and environmental laws and regulations. However, management expects to claim production credits under the Inflation Reduction Act, with estimated future year credits of $55-65. The acquisition of APS provides additional production capacity in Europe and an expanded customer base. Despite a decline in adjusted gross margin due to increased input costs, tariff costs, and unfavorable product mix, price increases were implemented to offset tariff impacts. Management believes it has adequate resources to fund its operating and financing needs through cash from operations and access to capital markets. The company is investing approximately $25 to $35 in Project Momentum tariff and operational efficiency initiatives in fiscal 2026 to drive growth. Overall, management's strategy focuses on operating activities, working capital, strategic investments, and debt reductions, with a commitment to defending against pending legal proceedings and addressing various risks facing the business. The company has made several strategic acquisitions in recent years. One notable example is the Advanced Power Solutions (APS) acquisition, which was completed on May 2, 2025. This acquisition contributed significantly to the company's net sales, with a total of $64.6 million. In addition to the APS acquisition, the company also acquired a business in Belgium during the first quarter of fiscal 2024. These acquisitions demonstrate the company's commitment to expanding its operations and increasing its market share through strategic investments. It is worth noting that there have been no divestitures mentioned in the extracted summaries. The company appears to be focused on growth through acquisition, rather than divesting existing assets. The company's financial activities have been transparent in their reports. On the matter of shareholder returns, it is clear that the company has taken steps to reward its investors. One such measure is the payment of dividends, which indicates a commitment to distributing profits among shareholders. This decision was made on multiple occasions, as evident from page 7 and page 42 of the report. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares, thereby reducing the number of outstanding shares and potentially increasing earnings per share for existing shareholders. The fact that this practice is mentioned alongside dividend payments suggests a deliberate effort by the company to maximize shareholder value through various means. Concerns about inventory buildup and supply chain disruption have been raised. On one hand, the company has experienced a reduction in inventory levels, with total inventories decreasing from $781.2 million to $720.7 million. This indicates a decrease in year-over-year inventory of approximately $87 million. However, there are also instances where inventories increased by $35.3 million. On the other hand, concerns about supply chain disruption are valid. The company's manufacturing facilities and supply channels may be subject to disruption from events beyond their control. Tariffs and transportation/logistical constraints are expected to continue in fiscal 2026, leading to increased input costs due to direct impact of tariffs. Additionally, temporary costs for transitioning the network to address tariff headwinds have been incurred. That concludes the financial summary for Energizer Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.